Gleaming skyscrapers of glass and steel pierce the skyline, housing the nerve centers of global finance. Within these walls, transactions worth trillions of dollars are processed every single day. Banks are pillars of our modern economy, yet they often seem like impenetrable fortresses of wealth. It begs the question, in a world of complex financial instruments and digital transactions, how do these institutions consistently generate billions upon billions in profit? The answer, while wrapped in layers of financial jargon, is surprisingly straightforward and built on three core pillars. At its most fundamental level, a bank operates on a simple, age-old principle. This is the magic of the net interest margin. Imagine you deposit your savings, say $1,000, into your bank account. The bank might pay you a small amount of interest for holding your money, perhaps 1%. But the bank doesn't just let your money sit in a vault. It lends that same $1,000 out to someone else, like a small business owner or a home buyer, but at a much higher interest rate, let's say 6%. The 5% difference between the interest it pays you and the interest it earns from the loan is its profit. Now, multiply that simple transaction by millions of customers and billions of dollars, and you begin to see how this core activity becomes a colossal engine for revenue. But the interest spread is only the beginning of the story. The second major revenue stream comes from a complex web of fees. Think about your own daily financial life. Every time you use an out-of-network ATM, there's a fee. If your account balance dips below a certain threshold, you might be charged a monthly maintenance fee. Overdrafting your account incurs a significant penalty. Credit cards, a staple of modern commerce, come with their own set of charges, from annual fees on premium cards to late payment penalties and foreign transaction fees. While each individual fee might seem small, the sheer volume of these transactions adds up, creating a steady and highly predictable flow of income for the bank, entirely separate from its lending activities. Finally, we enter the high-stakes world of investment banking, a realm far removed from personal checking accounts. This is where banks act as powerful intermediaries for large corporations, wealthy individuals, and even governments. They provide expert advice on massive corporate deals, such as mergers and acquisitions, charging immense advisory fees for their strategic guidance. When a company wants to go public and sell shares on the stock market, for the first time in an initial public offering or IPO, it's the investment bank that facilitates the entire process, a service known as underwriting. These are high-risk, high-reward activities that can generate hundreds of millions of dollars from a single transaction, contributing significantly to the bank's astronomical profits. So, from the simple act of holding your savings to the intricate choreography of a multi-billion-dollar corporate merger, the ways banks make money are both diverse and deeply embedded in our economic fabric. It's a powerful combination of earning interest on a massive scale, collecting a vast array of small but numerous fees, and orchestrating high-value deals in the world of high finance. Understanding these three pillars doesn't just demystify the banking industry. It reveals the fundamental mechanics that power the flow of money through our global economy.